Are you ready?
Ready.
All right, let's go. Kevin here, Top 1 Financial Advisor and best-selling author. We are here to talk about the stock market. With the stock market down 20% so far this year, there are a lot of people asking, hey, isn't this buying season? Like, shouldn't I just take the cash that you told me that I should have in my account and start to buy up a lot of these companies? Isn't this where I can get a lot of stuff for a discount? That answer is yes and no. Yes, there are a lot of companies that I would say, hey, it's discount season, this is buying season, dollar cost average season, call it what you want. There are a lot of companies that I think can set you up for the future. There are also some that I think are absolute traps that you want to avoid that I don't think are going to pay off this year, next year, maybe even the year after that. So you do want to be careful. Here's the thing. You have to know how to separate what is a buying opportunity and what is not, and what is going to continue to crash for the foreseeable future. Again, foreseeable future. I can't sit here and tell you that a company is going to be terrible for the next 10 years. I can say that I don't think things look good over the next, I don't know, year and a half. So here's the thing. Here's how you can really separate these two things. Yesterday, in our 5 things to do in a bear market, I said you got to pay attention to the business, right? Which means that you have to see how the company makes money, if the company makes money, and how those prospects are supposed to change or evolve over the next year or so. You can find all of this information in all the earnings reports that these companies put out. They put in plain English, here's what we are dealing with, here's what we're expecting, here's how much money we are making. They do this every 3 months, okay? And we're about to walk right back into another earnings season in the next few weeks, like, you know, starting mid to early July. We're gonna get a slew of companies coming back out and saying, hey, here's how we did. So to really walk this out and give you an idea of how this works and what to pay attention to, let's talk about a company like Coinbase that was in the news today. They are unfortunately laying off 18% of their entire staff. That's like close to 1 out of 5. More than 1,000 people are going to lose their jobs at a Coinbase because of the economics behind this. Or in comparison, rather, you can look at a company like Microsoft, who is hiring and paying more. Or you can take a look at a company like Salesforce. So I really want to focus on Salesforce and Coinbase. Now, I'm not on either side. I don't own either of these. I'm not even interested in either of these companies. But I do just want to give you the lay of the land. Right now, as of this recording, Salesforce is down. I think they were down like 43% when I looked earlier for the year. And then Coinbase is down 81% for the year. Clearly, they're both bad. Okay, they're both awful. The market is down 20. Salesforce is down 50. And then you've got Coinbase down 81. That aside, there are key differences between these companies. When you look at their most recent quarter, or you just look at just what's been happening for them this year, Salesforce is making money. At the end of the day, they have a positive net income. Net income is what is your revenue, which, by the way, for Salesforce, their year-over-year revenue is up 24%. So they made more money now than what they did a year ago from this point in time. That is powerful because Coinbase is not, and not every company is making more money today than what they were this time last year. So who is making more money? Who is profitable? So when we talk about net income, it's my revenue, what I brought in, all my bills, what do I have left over? Is that positive or negative? It's negative for Coinbase. Coinbase lost $430 million in just the last 3 months alone. That's a problem. And we'll see what it's going to be for the rest of the year. But here's the case. If I have a positive net income, which means I made products, I sold stuff, now it may be higher or lower than what it was last year. In the day, I got cash, right? I got money, pay my employees, do whatever it is I got to do, put the rest in the bank, invest the money, acquire a new company, whatever it is you got options, right? Especially when the market is down, you have options. But a Coinbase does not. If I'm down by the end of the year, I'm down in the last 3 months, I'm down $400 million, and that continues, and maybe I lose $1 billion. Here's your problem. You have to borrow. Because that's the only way that you're going to survive, right? You can use some of the cash in your bank, right, which you do have some, but at some point you have to borrow. If you borrow in this environment, what do you have to pay? You pay interest rates. here's the thing, interest rates are getting more expensive. We've been talking about that all year. Tomorrow or even Thursday, we're going to find out whether interest rates are going to go up by 0.75%. Remember, we started off raising interest rates by just 0.25, and then we said, ooh, this is not fixing itself. Inflation's still going. Let's raise it by 0.5. Now they're looking at 0.75. That headline came out, I think, this morning. So if I have to borrow money at this rate, and things are going to increase, it's going to make it even more expensive and even more difficult for me to grow. So if I'm cutting staff, I have to continue borrowing, and people aren't even interested in my product, like Coinbase. People are not interested in crypto at this point in time. These are all terrible signs for the company. We are not expected to stop raising interest rates until some point in 2023. That's not good for Coinbase. However, a company like Salesforce, or even some of the companies I've talked about before, Microsoft, Apple, all those, they're going to be fine. They're going to be, if nothing else, they're going to be better off than a company like Coinbase. This is not a, bash Coinbase session, but any company that is in this sector, meaning you have to borrow money, you're losing money, so you're borrowing, you're operating at a loss, and your customer base isn't growing, that's going to be an issue. And these are the things you have to pay attention to. For those that are making money, for those that have cash, those who are still hiring and still doing regular operations, those are the ones that are at a discount. Those are the ones that are, we can say, hey, this is buying season here. But those that are not, it ain't buying season over there. Okay, so you have to sit down and go through and kind of peruse through some of these reports, look at some of those earnings notes. The good thing is earnings are coming right back up around the corner. You're going to get the freshest reports you can get in the next few weeks. The numbers that I'm quoting and citing were from May. Now, May wasn't that long ago, but you guys get the point. So in July, I would say really second to third week of July, we should start getting another wave of reports from all of these companies about what they did in the most recent quarter. And that's where you can start to make your decisions. But that's the thing. It's going to come down. And it's the reason why, again, why Coinbase is down 80. And yes, Salesforce is not doing great, but I mean, down 50% or 40%, whatever it is today. Neither one of those are good. But the question is, what is at a buying season? What is buying season? What is attractive right now because it's come so far down in value? Which one of these is going to have an easier time to recover over the next 2, 3, 4 years? The easiest path to recover is probably something in a space that is currently profitable, doesn't have to borrow unless they want to, and they're in a space where people are still interested in, or they're a quote unquote institution. If Coinbase dropped off the face of the earth tomorrow, I don't think that much stuff is going to change. And honestly, the company is only 10 years old, so we all know a world before a Coinbase. Whereas, I don't know if we would be the same without an Apple. I don't know if we would be the same without Microsoft. I don't know if we would be the same without Salesforce. If you have worked a regular 9 to 5 that has to deal with customers or sales and that whole relationship management piece, you have dealt with Salesforce at some point in your life. And without it, things would look mighty different. So there's a reason why in a time like this where things are slowing down to a degree and companies are dealing with inflation, Salesforce still out here. In fact, again, I mentioned this before, their revenues are up. They are bringing in more money now by 24% than what they did last year. Not every company is doing that. So you really want to pay attention to what we call the fundamentals. Again, you can find this on the most recent most recent earnings reports, which for most companies was right around May. You're going to get another one in July, so feel free to take a look at those. And that's what is really going to determine, hey, I'm buying shares now for the future. This is a buy the dip moment. This is a cheap opportunity for me versus, oh, I hope that things turn around for some of these newer companies. Not every new company is going to be in that space. Some will, some won't. But that's going to be the determining factor. What is the demand? What is the business? Are they making money? Are they losing money? And how the world is going to react to that particular product. So before I go, one other example is kind of like NVIDIA. Each one of these companies are dealing with different things. They're all dealing with different things. NVIDIA is dealing with the supply problem. They're down, I think, I don't know if it was 40 or 50%. Everything feels like it's down 40 or 50%. But in either case, NVIDIA is dealing with that. If that can be solved, they would be better off. NVIDIA is still making money right now. They are still profitable. They don't have to borrow. They're forced to borrow, rather. they're financially, they could be doing better with the supply chain, being able to get their products to and fro, but they're okay. That might be a buying opportunity, even though it looks terrible, looks awful right now. Next 2, 3, 4 years, I can see that making sense. Also, without those chips, it's a lot of stuff that's not going to work anymore, right? So there's, you know, from regular cars to AI, computer system, all that stuff, it helps to run NVIDIA, AMD, all that kind of stuff. So you got to pay attention to that. What is profitable? What's going to work? What do we need and what don't we need? What could we do without? So any company that falls into those categories of, hey, I probably don't need it, the world will be fine without it, but especially you are borrowing money and you're not profitable right now, those are going to be the ones that are going to get hurt even worse than what they are currently. That's what's going to be the problem. And again, because interest rates are not going to just magically pause within the next year, at least it's not expected to, I don't really see any daylight for them in the foreseeable near-term future. So keep that in mind when you're looking at what is at a discount, what you should buy, what buying the dip means for some companies, and know that it is different for others. Right? So that is it for me. We're going to do some more deep dive breakdowns on how to find this information for our members only. You can join that by hitting the join tab below. We've already got some really good breakdowns, especially on Amazon and others, and how I interpret charts and what I decide to, decide when and where to buy and why. So I did an entire video last Friday on that. If you want to join those, make sure you hit the join now tab. All right, so for me, talk to you later.